For more on Wall Street's reaction, let's bring in Bloomberg's Alix. Alix, a pleasure. So what are they saying? Greece, Spain, as well as the housing numbers? That's not a good mix.
And also just very confused and complicated, because from yesterday to today, what fundamentally really changed in the headlines, right? Not that much. And yesterday we saw the rally into the close, and then today you see that big sell-off. But suffice it to say, the S&P still held that 1313 level. So see how traders will be playing that tomorrow.
You ever get a conversation with traders that says that there's a different group of investors in the bond market than there are in the stock market? Because if you look at the bond market, we had record low yields on the 10-year today. That's fear.
Right, and gold too. Talking about commodities getting totally squashed. Silver and gold did not, kind of playing out that safe haven trade there for once in the last couple months. That hasn't been the case. Some investors, well, some traders, especially those who follow the banks, were saying, well, maybe it might be interesting to buy on this dip. But in general, just saying the market overall, like you said, just looks really horrible. Really
Bank
scary.
stocks fell today as well.
Yeah, they were saying that maybe you can get some kind of intraday pop. Well, that didn't happen, and saying maybe for the long term, buying these at such a discount is a good trade. But you know.
Always talk about the long term when things go down, don't they? I mean, it's always about this opportunity, never
right.
about sell and panic now and avoid the rush.
Right. No, absolutely. Unless you're a gold investor, apparently, today.
Indeed. All right. Well, let's stick around, because I want to bring into the conversation Peter Andersen. He's a portfolio manager at Congress Asset Management, helping to manage over $7 billion. Peter, it's a pleasure to have you with us. So what do you make of today's market action in the context that in the first quarter, you got returns in the stock market that almost seemed like annual returns?
It was incredible. You know, when we started this year, the whole Greece situation seemed to fade into the background. Now, it's right much in the foreground, and I think we're going to see more of that now. The fact that Greece is really without a rudder, to coin a sailing analogy, is a real issue right now. And until we see something resolve in the middle of June with the elections, we're going to be rudderless for some time. And even when we do get resolution then, Pimm, I think we're still going to see a lot of volatility coming from that part of the world. There's just not a clear plan how to resolve any of these issues. And we have a short-term focus. We're evolving to be such short-term investors that you're exactly right. Back in January, it was not an issue. Now it's all over the headlines, and people can't think of anything but the euro situation.
Now, you talk about isolationist investing. What is that, and how does that actually work in today's society when you consider that, well, UBS says that Europe is 20% of global GDP? How do you get isolationist?
Great question. And what I was advocating is when you're looking for those that still have the courage to be in U.S. stocks, one of the ways to do that is to really know where the revenues are sourced from. So know your stocks really well in terms of the top line revenues. You can do that off a Bloomberg terminal, for instance. And by isolationist, I mean invest in U.S. revenues generated from the U.S. So if you look for companies, for instance, General Electric has a large source of revenues from Europe. That would not be an isolationist investing. Other companies that are small cap companies have very clearly defined revenue streams that are here in the U.S. So you would be sheltered somewhat from any of the volatility in Europe. You know, there are two things that are the issue there. Number one is the fear of the currency, the U.S. dollar rallying, but also there's just the generic fear that the European consumer won't have any buying power left. So we've got a double whammy that we're looking at. And one cure is to look just in the U.S. and say, I'm still bullish on U.S. markets, but I want to stay away from European revenues, i.e. be an isolationist investor.
Peter Andersen, to borrow a sailing phrase, because I know you're a sailor.
Yes.
A rising tide lifts all boats. So if there's a correlation between what's going on in the stock market, people seem to be selling things regardless of whether the balance sheet is great, whether they pay a dividend, whether it's a good company. So if you have this correlation, why not step aside, wait for the dust to settle, and then go back in if nobody knows what's going to happen?
It's the age-old question. What is market timing? You have described market timing to a T. And the issue is, when would you know to get in? It's always in retrospect. Even you started the show by saying, look back in January, this was not an issue. Now it is an issue with European investing. So we never can actually specifically time when these things are going to fluctuate. It's based on the whims of the behavior of the investor. So I would say if you still have the courage to stay in equities, there are plenty of good stocks that in the U.S. that you could probably get at a bargain. But for those that might feel more comfortable being on the sidelines, parked in cash, that is certainly an alternative. And I think you will be seeing more advisors making recommendations to get a little bit top-heavy in cash these days.
How much cash do you think would be a good allocation right now to hold
Well,
on?
currently, in my strategy, I'm about 15 to 18% in cash. I don't normally.
And how much is that
have
typically?
Yes, normally it runs very, very lean, 2 to 3%. But you know, it's a temporary parking strategy, and investors sometimes get concerned about that, thinking that they're leaving some upside on the sidelines, but I don't really think that's the case. When you have an extreme set of situations, which we do now, the 10-year Treasury so low, the German Bund being almost at a zero yield, when you have those things, I do think that any client would feel comfortable being in a higher level of cash temporarily.
Do the clients need to be a little bit uncomfortable? Because haven't you heard the notion that, you know, when the client calls and says, get me out, get me into cash, that's usually the buy signal?
It is a classic buy signal, yes. And what we try to do with clients like that is remind them back in August when many of them called and were saying, I can't stand this heat, we need to get out of the kitchen. But if you stick to the discipline of, say, a balanced portfolio and you hung in there, you saw what happened. We rallied double digits through the last part of that year and locked in at least greater than a 2% return. So history is the best guideline we have. We don't always repeat it, but it does appeal to investors when you look at case studies in the past and get a sense of what has worked.
And they say it rhymes, too. I want to thank you very much.